All right, let's cut through all the noise, all the complicated financial advice out there. Today, we are building one clear roadmap to creating wealth. We're going to break down every single major investment option you have. So, whether you're just starting out or you're trying to fine tune your strategy, this is the entire journey, mapped out from the safest of harbors to the high growth frontiers. Now, I know what you're thinking. That sounds absolutely insane, right? But that is a direct quote from our source, and it perfectly captures the almost magical power of compounding. So, how on earth do you get there? Well, the secret isn't some complex, risky trading scheme. Nope, it's a fundamental principle that's actually way more accessible than you think. So, this really is the big question, isn't it? What's the secret formula? Is it just pure luck? Being a genius? Maybe a massive inheritance? The surprising answer from our source material is it's none of those things. In fact, it all boils down to just two super simple levers. That's it.
Seriously, these are the only two levers you can pull to completely change your financial future. How much time you give your money to grow, and how fast that money actually grows. The rest of this deep dive is all about understanding how to master both of them.
But hold on. Before we even dream about mastering time and returns, we have to talk about something way more fundamental: protecting what we have. Our source is crystal clear on this. You can't grow wealth if you keep getting knocked back to square one. Most people lose money not from a bad investment, but because life throws them a curveball they weren't ready for. So protection always comes first. And that protection, well, it rests on these three pillars. They are absolutely non-negotiable. You've got health insurance for medical emergencies, life insurance to protect your family's future, and a solid emergency fund for basically everything else that can go wrong. Okay, now this is a really big one. This is a super costly mistake so many people make. They mix their insurance with their investments. Look at this, a pure protection plan, just term insurance, it's cheap. But these plans that mix in guaranteed returns, they can cost more than 10 times as much. And the kicker? After you factor in inflation, those returns are often terrible. So the takeaway here is crucial. Keep them separate. Insurance is your shield. It's not for growing your wealth. And that third pillar is your financial shield, your emergency fund. So how much do you actually need? It's a pretty simple calculation. Just add up all your essential monthly costs, your rent, food, bills, all that stuff, and multiply it by 6. Boom. That gives you a 6-month cushion to find a new job or handle a crisis without wrecking your financial goals. And ideally, you want to build that up to 12 months worth of expenses. Now, this fund shouldn't just be sitting under your mattress. You want it to be safe, yeah? But you also need to get to it fast. The source suggests breaking it down something like this: the biggest chunk in a fixed deposit, so it's safe and earns a little bit. A good portion in your regular bank account for easy access. And a small amount in actual physical cash for those true get-it-now emergencies. All right, foundation is secure, our defenses are up. Now we can finally talk about the fun part, investing. And the single most important rule in all of finance is this relationship between risk and return. Let's be real, there's no such thing as a free lunch.
But first, let's redefine what risk even means. In investing, risk doesn't mean you're guaranteed to lose your money. It's all about volatility. The ups and downs, the bumps in the road. The stock market is considered risky because it fluctuates like crazy, not because your money is destined to just disappear. Getting this difference is absolutely key. Now, I want you to look at this number. Just burn it into your brain. 72. It's one of the most powerful, simple mental shortcuts in all of finance, and it's going to help you understand every single investment we're about to talk about. It's called the Rule of 72. All you do is divide 72 by your expected rate of return, and that gives you the approximate number of years it'll take for your money to double. Simple, right? So, an investment earning 7%, it'll double in about 10 years. One earning 15%, that'll double in less than 5 years. This little trick is a total game changer for putting things into perspective. So, let's put this new tool to work on our first investment path. This is the safe lane, right? It's all about stability, protecting your initial capital. The returns are modest, but so are the ups and downs. And with a return around 7%, our rule of 72 tells us our money will take about a decade to double. And here are the classics, the usual suspects: fixed deposits at a bank, provident funds, those government-backed retirement savings plans, and a few other government schemes. Digital gold also kind of fits in here. But here's a crucial tip from the source. Avoid buying physical gold jewelry as an investment. Between the making charges and taxes, you're often losing money the second you walk out of the store.
Okay, now we're moving into the middle lane, we're picking up a little speed. Here we're accepting a bit more volatility, a few more bumps, in exchange for a shot at significantly higher potential returns. This is where wealth generation really starts to kick into high gear.
So one option here is corporate bonds. This is basically you lending money to a big company. The main risk is that the company could default, meaning they can't pay you back. That's why credit agencies give them these ratings, like you see here. To play it safe, the advice is simple. Stick with the highest rated stuff, the AA or AA bonds. But really, for a lot of people, the heart of this balanced path is equity mutual funds. And this chart of historical averages, well, it tells the whole story. Large cap funds, which invest in the big stable companies, have lower risk and lower returns. And then you have small cap funds investing in smaller, high growth companies. They offer much higher potential returns, but you guessed it, a lot more volatility.
And finally, we arrive at the fast lane, the high-stakes path. The potential returns here are just astronomical, but so are the risks. Let me be clear, this is absolutely not for beginners, and even seasoned investors need to tread very, very carefully here.
The numbers here really speak for themselves. According to data cited in our source, a staggering 82% of people who try active stock trading lose money. 9 out of 10 startups fail, taking all that investor money down with them. And crypto, it's so wildly volatile that it should be a tiny, tiny fraction of your portfolio, if you even touch it at all. It's crucial to see these for what they are. Not really investments, but highly speculative bets. So, we've seen the paths. Low risk, medium risk, high risk. Now let's put it all together and see what the difference in that rate of return actually looks like over time. This is where the magic really happens.
Let's make this real. Imagine you invest 1 lakh on the safe path, a fixed deposit earning 7%. Using our cool rule of 72, we know the money doubles about every 10 years. So after 20 years, your 1 lakh turns into 4 lakh. Solid, predictable, nothing wrong with that. Now, what if we take that same 1 lakh for the same 20 years, but put it on the balanced path? Let's say a mid-cap mutual fund averaging 15%. At this rate, your money is doubling roughly every 5 years. And the result? 16 lakh rupees. That is 4 times more than the safe option. The return rate was only about double, but the final outcome is 4 times bigger. That is the power of compounding.
And now, for the grand finale, what happens on that high-stakes path? If you somehow managed a high-risk, high-reward return of 30%, your money doubles roughly every 2.5 years. After 21 years, that same 1 lakh, it wouldn't be 4 lakh or 16 lakh, it would become an incredible 1.28 crore. The difference isn't just big, it's absolutely life-changing.
So you see, the rule of 72 isn't just some clever math trick. It's a practical tool for your future. The difference between your money doubling in 10 years versus 5 years changes absolutely everything. So the final question isn't for some financial expert. It's for you. Based on where your money is right now, how long will it take to double? Answering that question is the very first step on your own path to wealth.